I think that a chart in the employment may be here. It doesn't show the statistics immediately, and it's not significant. When you turn a large boat, it turns very slowly, and you don't even perceive it initially. So yes, I think that a chart in the employment may be here. It doesn't show the statistics immediately, and it's not significant. It's not going to accelerate it's going to slowly turn from 3 to 3.5 to 3.75, and then it's going to accelerate as the recession deepens.
Join us in this enlightening discussion with Milton Berg, the seasoned investor and founder of Berg Advisors, as he provides unique insights into the current state of the economy and the stock market. Milton shares his investment thesis, offering valuable recommendations on which sectors to be overweight or underweight. He emphasizes the importance of carefully analyzing banking stocks and small-cap opportunities while shedding light on potential market challenges. Without further ado, let's listen in.
Character, and on February 2nd, the day the New York Stock Exchange, we had supply line peak, S&P 600 peak, the Russell 2000 peak, S&P mid-caps peak. So there was a change of character in that market because you saw panic into that top. There's some gaps in some indices into the top and immediate reversal. Now the reality was that top has held from many markets. The February top has held from the Russell 2000. The February 2nd top has held from the S&P mid-caps, S&P small caps. It's certainly helped to the retail sector. The retail sector that's collapsed on a price-weighted basis, not a price-weighted, but on an equal-weighted basis, opposed to a cap-weighted basis. It's collapsed since then. So February 2nd wasn't a change in character. Then we noted it was the bottom in March, a short-term bottom, which took the markets higher. But we still see another change in character now because I don't want to get too technical, but the action of the NASDAQ and the action of the S&P 500 on June 16th and again on July 3rd, 4th, 5th show signs of the top as opposed to signs of acceleration to the upside. People seem to think that the market moves off fundamentals, but the reality is fundamentals change very slowly. And the market is very often confused, and the market is often rallying in the face of negative fundamentals. Sometimes it's justified because the fundamentals will turn positive later on. It can be a deep recession, it can be a deep depression, and the market can start rallying because the market's anticipating it will come out of it. So no, I think that the fundamental basis things haven't changed that dramatically because basically the Fed has been tightening since last March, April. And the last March, April, meaning 2022, there was tightening, and interest rates basically are way higher than they were 2-3 years ago. So on a fundamental basis, the things that caused bear markets are still in place. You have a Federal Reserve tightening, you have the so-called quote-unquote inverted yield curve we've been talking about. And so I don't think fundamentals changed that dramatically. It's a market perception that changed dramatically. A market, so I would say that when I see the change in character, the fundamentals may have been negative all along. It's just that the market was fighting it. Maybe the market was no longer fighting it. Or maybe, it's a straw that broke the camel's back. Maybe when they raise rates 1 time, 2 times, 4 times, 6 times, 9 times, it's not enough to break the economy, break the market. Maybe there's less push in the economy in July. Maybe that's big enough to break the economy. Maybe the market's anticipating that. But we do know that on June 16th, you had a panic, you had gaps into the S&P 500. On July 3rd, you had gaps into the NASDAQ and the X and so on. And then they reversed to the downside. Plus, you know that the D-line peaked way back in February, and the Russell peaked way back in February. And that's not a sign of a healthy market. So the fact that the S&P 500 is rallying looks great, but the fact that it's rallying on its own with the rest of the market flat is not a healthy sign at all. It's never been a healthy sign in the past. I said in the past, it's the S&P which comes back down to where the market is, as opposed to the rest of the market rallying back up to match the S&P. That's how historically. We all know there was a devastating bear market in the U.S. from 1929 to 1932, where the market lost 80, 90%. So many companies were bankrupt, but the indices went down 90% or so. And then the market had declined to 1932. And that's sort of a weak rally, almost a nice rally from 1932 to 1937. But the averages were not really reflecting what was going on because there's one famous stock called International Business Machines, IBM. In those days, it had a different name. That was taken out of the Dow in 1929 for some reason because they felt that no longer growth stock. It turned to be raising growth. If you would have had the IBM and the Dow during that period of depression, you wouldn't have seen a 90% decline. You wouldn't have seen the rally also 32 was literally much greater. There was the glamorous stocks of the 20s, RCA, General Motors, actually crashed with the depression. It didn't do so well, but IBM, which was taken out of the Dow, did very, very well. What I'm pointing out is even in a great bear market, if you have a great company with great earnings and great potential, that can hold up even in a bear market. That's what people are saying is taking place with Tesla. They're saying it's taking place with Apple. They're saying it's taking place with Google. They're saying it's taking place with Amazon. I don't buy it. I don't think Tesla is immune to a declining economy. I don't think Apple's immune to a declining economy. I don't think any of these stocks are really immune to a declining economy. It's just that the economy really hasn't started declining yet. If we're going to get a decline, which the market maybe started anticipating last year, but maybe this peak right here is going to start anticipating the next decline. Maybe in the next decline, these stocks will come down. Why these stocks move up now? Basically, they're not doing as well as we've done in the past. And everybody owns an iPhone, everybody owns a PC. They're not as if there's so much new growth coming and try to find the markets. But again, there was a liquidity buildup by the Fed for over a decade, and that liquidity has found its way into assets, and it's found its way into these growth stocks beginning December 28th into roughly June 16th or July 3rd. But maybe it's a short-term where it's going to end. So you can say, yes, why did it happen? Because people are buying the stocks. Why are they buying the stocks? These companies showing earnings, and I think the companies have more resiliency than the other companies. But if there'll be economic downturn, I don't see why the stock will be safe. I really don't think they will be safe.
Let's talk about
Apple Computer is a great company because they have the iPhone. But ultimately, people are going to buy the iPhone if they can afford the iPhone, and companies are going to advertise with the iPhone because they can afford to advertise or the market conditions are good. Apple is dependent on the rest of the economy for the success. The Tesla is also dependent on the rest of the economy for the success. In other words, Tesla may be relative to General Motors, relative to Mercedes-Benz, relative to Chrysler, relative to Toyota. They can do very, very well and gain market share. But they're not going to do relative to economy when the economy is declining. So I don't think that there's really any of these growth stocks that are immune to an economic decline. Now, we haven't had the economic decline yet. You see, because there's still liquidity in the system that the Fed hasn't drained yet. But the Fed is doing, the QT, they're doing quantitative tightening, they're doing a pretty good job of tightening. They didn't raise interest rates as dramatic as they should have, considering the inflation rate. But they certainly have been draining liquidity on the money supply to the extent that they should. They're really very aggressive about that. And these things lag. We just started this a little over a year ago, and there's no clear-cut rule as to how long it takes for monetary policy to have an effect on the economy or on markets. It had an immediate effect on the market because you had a bear market that ended in October, seems to make it October, but they didn't yet have a major effect on the economy. You had the quarterly growth of negative GDP growth. You did have that, but it was very, very mild. And earnings were still holding up somewhat, and jobs, unemployment was holding up. Employment was holding up. But in effect, if the market now change of track is anticipating a decline in the economy, I don't think any of these sectors will be immune at all. Tesla was a very oversold stock. Late last year, there was a lot of tax law selling, which took the market down in general. Let's just look at Tesla for a minute. Let's just look at Tesla. I want to get some idea when we talk about the 100% gain in Tesla. Let me just get this Tesla. Okay, look at Tesla. Look at the chart, Tesla. Very nice, 100% gain, but the reality at today's price, Tesla is down 34.87% of its all-time high. So, in reality, I can easily make a case that it's 100% rally in Tesla, the rally in the bear market. The reality is, we make it even stronger. Tesla's high on July 5th, roughly 282. The lowest price level on September 19th of 2022, 309. So guess what? This 100% rally may just be what's it called? A retracement. It may just be they call it a dead cat bounce. They're looking at dead cat bounce because it's 100%, but relative to the decline it's at, you got to expect, even in bear markets, stock market rally. I want to point something out about the banking index, because that's a nice volatile index. During the great banking crisis of 2007, 2008, the BKX, which is the regional bank index, had a 70% rally lasting 2 months. From I think it was like August to September, from July to September of 2008, rallied 70%. That's a banking index. So for one stock to rally 100% over a 2, 3, 4, 6 month period in a long-term bear market, doesn't really not significant. I don't think it really means much. if you tell me it rallied to all-time highs in a breakout fashion, but if you look at the chart, it peaked in December or January of 2021-22, made a lower high in January, a lower high in March, a lower high in September, and it's making a lower high now. So I don't see anything technical or even fundamentally about that. Tesla's margins are decreasing. Tesla's, not as if Tesla's making it, the earning growth rate they had in the past. They're just happening, they're not taking market share because they definitely have a better product than Ford has. They definitely have a better product than General Motors has. I think the only competitor that I see is Kia. Kia has a very nice product. Other people are way behind the curve. So I would say that, no, Tesla's rallying is meaningless. And let's put it this way, if now we wake up and we're heading in economic decline and the stock market down 30% from the where it is today, I think Tesla will be down far more than 30%. And no one will be surprised about that. No one will say, how could Tesla decline 30% if it was up 100% in the first quarter of last year? Well, the first half of last year is really not a question. Markets fluctuate. And people, markets make mistakes and markets anticipate. Maybe the market anticipating the Fed won't tighten, the Fed will continue to tighten. We don't even look at tighten. We don't know what the Fed's going to do. We really do the best we can with the information we have. I don't think the fact that Tesla's around 100% is significant at all to tell you what the future of market of Tesla will be. I don't think it helps at all.